Welcome to ODEON Capital Conversations on all things money and markets with Dick BOVE and Matt Van ALSTYNE. And here is your host, John Aidan Byrne.
On this episode, we look at where next on US interest rates, the markets and the economy after US inflation cooled more than expected in the latest CPI report. Dick BOVE says inflation is now coming under control. Matt Van ALSTYNE says the Fed is in a very strong place to hold rates steady or even start cutting rates in response to economic conditions. Dick is out with a new report on the fast rise in the net worth of American households and non-profit institutions. The Federal Reserve puts the number at $154 trillion. We look at the US money supply, we look at the recent labour market numbers, and at the view of one commentator who says the trend line, in his words, is getting relentlessly worse. The emergence of inflation in Japan has lifted some spirits in this nation, bedeviled by falling prices for decades. China, meanwhile, is now grappling with deflation. We look at the latest on the wars in Israel and in the Ukraine. Opinion polls show Ukrainians are less optimistic on the war since May. And we'll have lots more. I'm with Dick BOVE, Chief Financial Strategist at ODEON Capital Group, and Matt Van ALSTYNE, ODEON Co-founder and Managing Partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 95. Inflation seems to be easing. New numbers out this morning. Prices rose 3.2% for the year, down from 3.7% annually in September. So inflation running at 3.2% in October, flat for the month. Core inflation is also headed in the right direction. Your thoughts, where does this leave interest rates, and just your overall feeling about this? Is this good news? I would hope it is.
Well, it's very good news. I mean, basically, the month-over-month numbers show that there was no increase in the CPI at all in the last month, and it shows that the core inflation rate, which is without energy prices and food prices, went up at, I think, 0.2%, which means that inflation is definitely coming under control. And that's what the equity markets are looking for. I mean, basically, the market has taken off like a rocket today under the assumption that inflation has been beaten and that the Fed no longer has any reason to control, interest rates or to control the money supply, and therefore interest rates are going to come down. And what we're seeing from analysts all over Wall Street is kind of a guessing game as to who can come up with the biggest number of how far interest rates are going to drop in 2024. My problem is that I don't think that the Fed is going to ease dramatically in 2024. I think if we go a little bit later into the numbers concerning the amount of money available to households in the United States, it is so huge that I think that's what the Fed is fighting at the moment. And I think, therefore, that the Fed might remain tough, for a much longer period than people expect.
Well, we'll get into those Fed numbers in a moment, Dick. I know the euro rose and the dollar dropped a little bit in response to the inflation numbers, which I always found kind of interesting, and it's some kind of a barometer. Why would that be? Is it because the sentiment is that interest rates won't rise any further and the Fed is done with his work?
Well, it's because of the relative. In other words, when you're taking a look at currency movements, you have to consider two things: the interest rate differential between one nation and another, because presumably people want to get the highest interest rates possible, and secondly, the value of the currencies from one nation to another. So, if you assume that interest rates are going to if you assume the inflation number is going to cause the Fed to lower interest rates, that the bond market rates are going to continue to come down, then you're further going to assume that the value of the dollar is going to weaken a little bit, and that therefore leads to money leaving the United States and going to other areas where the risk-adjusted return on the currency is higher.
Let me just put this out. Gas prices are down quite considerably in recent months. I mean, could prices go back? What would make prices rise? Obviously, the Fed seems to be doing its job, but just plain sort of pushback, devil's advocate. Could prices rise? Any concerns about that?
Well, what would cause prices to? I mean, again, I always take the monetarist point of view, which is not, any longer believed to be a good way to look at things. But if you take a look at the monetarist point of view, we saw prices rise dramatically when the money supply of the United States basically exploded in 2019 to 2022. We saw prices start to ease in the middle of 2022 when basically the Fed, turned direction and started to shrink its balance sheet and shrink the money supply. And, at the present time, the money supply of the United States is down 3.4% year over year. And if that, continues, it's hard to imagine inflation turning around and going up. Again, if you take the monetarist point of view. So the answer to your question is what would make inflation increase again is if the Fed all of a sudden turned around and started printing money. Now, why would they do that? They would do that if the United States ran a massive deficit and someone had to print money to pay for the United States deficit. So if we run a large deficit, uncontrollable deficit, similar to what happened during the pandemic, then, the Fed is going to print money. And if the Fed prints money, we're going to get inflation back. But at the moment, Congress seems to be fighting over whether, the deficit can be controlled or not. If you get away from all the personalities and the hyperbole in the press, there is an issue there. And the issue is, the United States owes too much money, that, the interest on the debt is now staggering in the hundreds of billions of dollars of level. And, there are a number of people in Congress who want that deficit to come down and want, in essence, interest rates to drop so the United States is not spending all of its money paying interest on the debt. So, basically, there are positive signals coming out, even though it's hard to see them.
I want to interject here a little bit, Dick. The difference between the recovery from 2008 to, call it, I shouldn't even use the word recovery, but the Fed's actions from 2008 to like 2013, 2014 was all the money printing that occurred was contained within the financial system. They were by and large, changing interest rates and then doing quantitative easing by buying up federal bonds that otherwise wouldn't have a home and did that to help contain interest rates. And if I recall, from 2009 through 2015, everyone was talking about you can't print money like this, else you're going to have massive inflation. And the monetarists, as you call them, but I think what you're saying is that the famous quote that inflation always is a monetary phenomenon. Were kind of proven wrong because we didn't really see a great deal of inflation when it was only the Fed. Where we see the inflation was from the PPP. And just the multiple levels of handouts to consumers and to small businesses that happened during COVID. So it was more of a fiscal money printing than a monetarist money printing situation in 2020, 2021, 2022. That, in my mind, I think you can differentiate when the money printing is coming from the fisc, from Congress, when it's going directly into the hands of consumers. You clearly see the direct line of money printing and inflation. But when it's just QE and it's just moving around sloshing around within the financial system, it seems like it has a different outcome. And then with regards to inflation, I've been spending all morning going through the components, and the headline number is 3.2, but what makes up that 3.2 is almost entirely core services. And the biggest component of core services is rent. And it shows that rent is increasing month on month by 2.2%, which is not consistent with, the national rental numbers that come out that show rent year on year is down 1.2%. So I went back and tried to compare where rent has come from. And I don't know if you remember, but about a year and a half ago, when we were talking about how inflation was around 6 or 7%, and, at that point in time, they had rents being up 6 or 7%, but we were discussing how in real time rent was actually up, I think 18 or 19% at the time, and that rent being a lagging indicator, if they had made it more of a concurrent indicator, we would have had much higher inflation a year ago. And what we're doing right now is just playing catch up, because the actual concurrent measurements are showing that rent is basically flat, if not down, and yet the CPI index is almost entirely reflecting, rents running away. And so I think rents are much more of a lagging indicator the way the CPI is measuring it. And if you were just to normalize rents, we would have 0% inflation right now. And so I feel like the Fed is in a very strong place to hold rates steady as long as they want, and then their next action will be to cut if the economy needs it by running into a road bump.
I agree with everything you just said. In other words, I agree that if you expand the money supply, in other words, if all you're doing by printing money is taking money away from the private sector and putting it into the public sector, but not expanding the size of the monetary base, then, that's not inflationary. It's actually deflationary. And if you, however, go out and increase the size of the monetary base, which happened beginning in 2019, then you are basically going to increase, inflation. And I think, you had money supply at one point up 26% year over year. I mean, how that cannot be inflationary, is amazing to me. And now money supply, as I just mentioned a moment ago, is down 3.7% year over year. And that, in my view, puts tremendous stress on the ability to raise prices. So I think everybody's clapping their hands and really happy about the fact that inflation seems to be under control, and I agree with that. But I think that we're heading in the wrong direction economically, and that's something that we're going to have to deal with in 2024.
Yeah, I agree with you on that. I just think that what I'm trying to say is that I think the Fed does have the ability to reinstate QE without stoking inflation, and the inflation fear would be coming if the Congress were to do some sort of massive stimulus package because of whatever economic event is happening. I think the fear of inflation comes from the Congress, not necessarily from the Fed.
Yeah, this report that I came out with today basically makes that argument. It says that, in other words, we did a series of regressions. I wanted to find out why, we had this massive increase in the outstanding wealth in the United States, between 2019 and 2022. And I took the numbers in order to make the regression reasonable. I went back to 1980 and I compared the federal debt to the actions of the Federal Reserve. And there's unbelievably high unbelievably high correlation, 96%. And then I took the increase in the Federal Reserve balance sheet and compared it to the money supply. And again, you had this tremendous correlation. Then I took the money supply and compared it to total debt outstanding in the hands of households in the United States. And again, bango, the two, are right together. And then I went one step further and I took the liabilities and compared it to the financial assets. And again, a perfect correlation. And that, of course, was a perfect correlation with the increase in net worth. So what it shows is that there's this chain, and the chain starts with the federal debt. And if that federal debt keeps rising, the Fed keeps buying that debt, money supply keeps rising, then liabilities will rise in the economy, assets will rise, and the economy, will increase wealth dramatically. Now, whether it's going to be solely from inflation or, whether it's going to be from increasing productivity, we have yet to see. It was through inflation in the past, but this has been true for 40 years now. It's not a new phenomenon. And so if they can get control of that deficit, it is going to do wonders for the United States, I think.
Let me take you through those numbers, Dick, because in the report you referenced there, and there's several reports you've put out, you say Americans in the first 230 years of our nation built up a net worth of $66 trillion. Then we had this big surge in overall net worth since 2010. Americans added, you say, 88.3 trillion, bringing the total to a massive 154.3 trillion. And the phrase you use is Americans are unbelievably wealthy. My question on that is how much of it is inflation adjusted or inflation influenced? Because if the cumulative price increases since 2010, according to a calculator, was 41.15%. And then the population increase. And then we had stimulus spending. So are they as unbelievably wealthy as your numbers suggest?
Yeah. I mean, I think that basically I'm playing in currency, the exact currency. In other words, inflation is due because you have a lot of currency outstanding. You say, well, the price of my house went up and my net worth is higher. That may be true, but it will only stay up if somebody has the cash to go and buy that house at that higher price. And the same with the stock market. You got to have the cash to go and pay for it at a higher price. You didn't get more than 100% increase in the net worth of the United States in this 10, 12-year period because of inflation, because inflation didn't come anywhere near that number. So even the number that you threw out, and they're not my numbers, by the way. These are numbers published by the Federal Reserve, and all of the data that I use comes in this particular report comes from the Federal Reserve. None of it's speculation on my part. None of it's taking actual numbers produced by the Federal Reserve and applying a whole bunch of statistical, if you will, rules to them to determine what relates to what else, and what we see very clearly is that, again, if you're going to increase the debt dramatically, you're going to increase wealth dramatically. Now, I know that's kind of modern monetarist theory also, which I'm not sure I agree with, but the numbers are very clear. It's just very clear what's happened. It is beyond belief that we created more wealth in the last 3 years than we created in the 230 years prior to that. And it wasn't all inflation. It was increase in money availability that did it. But those are staggering numbers.
Truly staggering. And then I wonder how we square the massive increase in debt, Dick. How does a debt net out if we have so much debt in America, consumer debt? Does that negate some of this incredible, just amazing increase in wealth? If we didn't have so much debt, this would be total paradise, America.
Yeah, but the relationship of debt to, 154 trillion in net worth, and there's only 20 trillion in debt. There's only 20 trillion in debt against 154 trillion in net worth. I mean, the stock market's up close to 500 points today because of that 154 trillion in net worth, which, this is the most of it, the greatest portion of it, 70% of it is, financial assets. It's not hard assets like houses, and houses are the main source of wealth for on the real asset side, but it's financial assets. And the bulk of the financial assets in periods like this, is the stock market. The stock market can, in 3 periods that we noted in this report, the 1990s, the period in this 2019 to 2022, the stock market was more than 50% of the growth of financial assets held by Americans, and that was equal to or more than, depending upon the period, the growth in the value of real assets. And so you can only do that if you just keep pouring money. But Americans, we talk all the time about, the downside. The reason why I wrote this thing is because I was sick of talking about how many people are in debt, how many people have got, problems, etc. The massive amount of Americans are not, in debt. up to their ears. I mean, only 25%. I mean, this is one of Matt's theories, but only 25% of the value of housing in the United States is backed by mortgages. 75% is equity that they have, that people have in their homes. I mean, Americans are filthy rich.
It's just it's very interesting what you're saying, because the narrative out there is all negativity, and we've piled it on a little bit on this podcast. Sure. But there's a lot of positivity, but it doesn't emerge enough, I guess, in media.
If you go, when I started working, a long time ago, in order to get an account at JP Morgan, you had to have $1 million, right? Well, everybody's got $1 million now. That's an overstatement, but you now have to have $5 million. In other words, you're not considered to be wealthy. Northern Trust is another example. I mean, if you want to take a look at the money managers and who they consider to be wealthy or not, you got to have 5 million. If you don't have 5 million, you don't hit that barrier. So, and if you take a look at the numbers that companies like Morgan Stanley and Bank of America put out, they'll tell you how many, and I don't have them in front of me and I don't remember them, but there are thousands of people who become millionaires every year. Thousands, not a small amount. And so Americans are not in deep trouble. There is a large population which is in deep trouble. But, in terms of the vast majority of the households, I can't wait for the New York Fed to come out with its, quintile study of who's got how much wealth and what level the wealth level is. But these numbers are shocking. They're just absolutely shocking.
Realistically, Dick, I don't have the numbers at my fingertip. There are massive amounts of Americans in major trouble with debt.
There is, but we over-concentrate on them. I've been over-concentrating on them. On the podcast, we've been over-concentrating on them and pointing out the fact that there are maybe 40% of the population, that is not living, the life of luxury that I'm talking about. I'm not forgetting that. But what I've forgotten in these comments that I've been making is there's another 50 or 60%, and it's not the top 1% or the top, 10% of the population. Wealth has gone through, measured in dollars. All right. Wealth is gone through huge portions of the population.
I think you're over-exaggerating the situation.
It might be.
I agree that the number of millionaires has grown. I think, I don't want to make up the numbers, but it's grown substantially in the last 3 or 4 years. And there was a New York Times article, I think 2 or 3 weeks ago, that went into detail about how the group that got the wealthiest in the last 3 or 4 years was not the top 1%. It was the next 10%. It was the people that went into 2020 with net worths, of hundreds of thousands of dollars, call it $300,000 to $700,000. And they came out of 2023 being worth 1.5 million, because whatever happened really benefited that particular group of people. It's people with upper class middle incomes, hundreds of thousands of dollars a year of income, own their own home, have very little mortgage. The home prices go up rapidly. They can tap into that home equity credit and invest elsewhere. And it's just the broad net worth of that, like, top decile of income earners in the United States is where the growth has been, kind of to the exclusion of the billionaires and the trillionaires. But I agree that there's a lot of wealth in the country, but like if you look at the data on the medians and the means of like retirement account, how many people have $1,000 in a checking account in case of an emergency, and there's a good 30 to 40% of the country that is, living paycheck to paycheck, and it just doesn't apply that they're wealthier than ever.
And both of you have referenced the Gini coefficient.
Correct.
Yes.
Widening.
We both love it.
Yeah, inequality.
Yeah, but I mean, again, we can focus all we want on, the people who are in trouble, the people who are reaching difficulty. I mean, I have sell recommendations on, all of the consumer-oriented companies that I follow, right? In other words, it's because of the fact that these people, who are borrowing this money can't repay it, but they're not driving the U.S. economy. They're not overwhelming the people on the other side of the equation who actually have a great deal of money. My son-in-law, asked me this question. Again, John loves this. My son-in-law asked me this question because he's an airline pilot, right? So he's making above average income, we'll have to say, and he's now building up these I'm going to say multi-million-dollar positions, and he wants to know. The question he asked me is, "Am I rich?" And I said, "Well, if you don't have 5 million, you're not rich."
Oh,
He
come
doesn't
on.
have 5 million. So, he may be a millionaire, but he's not rich.
I heard a good definition of rich the other month, and I've kind of adopted it. Like there's three levels of when you're rich. The first level is when you can go to the grocery store and buy whatever you want and not have to worry about looking at the prices. You're comfortable. You walk in, you can afford your food. Your house is, you can afford your house and you can afford your food and you're not stretched on a budget. And that's level one of rich. Level two was you can go to any restaurant and not be stressed out about the prices. Your life is so good that you can just go out and dine and it's not part of your budget. And then level three, when you've really reached the top, is when you can travel anywhere in the world, however you want, and you can afford it and you don't have to look at your budget. And I kind of thought those, the measuring wealth in terms of like peace of mind is a much better way than using a dollar amount, because New York City, $5 million, it's not as lot as if you're living in Des Moines, Iowa. I bet $5 million gets you a lot.
Yeah, I've traveled some of the country, and I'm amazed at the difference in housing prices in the New York area and let's say Southern Illinois. You could buy a mansion in Southern Illinois on 20 acres.
And have money left over for your Ferrari.
Exactly.
And that barely gets you a 3-bedroom apartment in New York City. I think
and so, Dick, applied to Wall Street, because you have a report out, has the asset management industry peaked? Because we saw these wealth managers accumulating a lot of assets in the past number of years. And McKinsey has an interesting report. It said there was a 40% increase in total direct brokerage accounts opened since the start of 2020, more than 25 million new accounts. And I thought that some of that was related to the COVID stimulus spending. People were at home opening brokerage accounts at that point in a frenzied fashion. But what does it mean for the wealth management industry?
Well, what it means is that there's been they didn't just open up brokerage accounts because they were sitting at home. They were opening up brokerage accounts because they were increasing their wealth. I mean, financial assets in the United States grew by $29 trillion in that period of the COVID disaster. Just looking at the numbers here, and the bulk of that money was going into stocks and mutual funds and pension funds, and the asset management industry was explosive. And I use Morgan Stanley as my example. I mean, they made the brilliant move at the beginning of this period to shift the nature of their business away from investment banking and brokerage and into asset and wealth management. They bought E-Trade, they bought Eaton Vance, which is a Boston money manager. They bought another company which deals with handling 401k plans for employers. And they exploded in terms of their earnings, in terms of their return on investment, et cetera. So my argument, which Morgan Stanley is not happy with, essentially is, okay, now what happens if you don't have the same growth in money supply at the same low interest rates? Can you continue to grow your business? And they said, their response is, the rich always get richer. The rich always get the benefit of whatever is going on in the economy. And so, yes, we will take the 5 trillion in assets that we now manage, and it'll be 10 trillion in a few years. And in my view is, no, it's not going to happen. It's not going to happen, because whether people in Washington want to spend this money or not, they're not going to be able to, because we're paying too much interest on the debt. They're not going to be able to, because there is a coterie of people who actually do want to control the budget deficit. So if they control the budget deficit, and if the Fed, continues to follow its policies, which is shrinking its balance sheet, asset management is just not going to grow at anywhere near the level that it did previously. And now you got the second problem. Everybody in the financial industry, I don't care if it's Bank of America and Goldman Sachs, if it's, you name the bank in Keokuk, Iowa, they're all going after asset management clients. And how are they getting them? They're cutting their prices. In other words, a number of years ago, if you wanted your money run by a hot hedge fund manager, you would have to pay 2% of the assets that you provided him to run, and he would take 20% of any profits that were generated. Nobody can pull a deal like that now, right? So the net effect is more asset managers, more price competition, less availability of funds. And in my view, that's asset management is not the business that you want to be expanding in. But all these companies are doing it. You cannot find a large financial institution in the United States, from JP Morgan on down to, as I say, Comerica, we'll say well, they're now in Texas, but they were in Detroit. They all want this ultra high net worth client. They all want this high net worth client, and they're willing to spend a lot of money to get them, and they're willing to cut prices to keep them. And therefore, I just don't think that asset management is going to be the place you want to invest in at this point.
Dick, do you think that changes with interest rate, like with bonds? You can buy 2-year treasury with a 5% yield. Like, active management is actually kind of back at these higher interest rates in my mind. And so I feel like one of the reasons these asset managers have been chasing passive investors is because of the low interest rates. Do you think that changes as investors get used to risk and reward in the current market?
Yeah, absolutely. I think that the game now is you've got to show performance. In other words, you've got to be in the top quintile in terms of performance if you're going to attract this money, because just cutting the cost of running the money is not going to do it. And if you really want to hold on to your clients, you've got to perform. And real estate's not going to do it for you either, because everybody set up these investment mechanisms and they went after real estate. That was alternative investment. You're going to have to find really smart people who really know how to pick stocks and beat the market. And I think those people will gather the available funds, as opposed to simply saying, okay, I'm going to put it in the S&P 500 fund run by Wellington or whomever. I don't think that game is going to work as much any longer. It was a no-brainer for 5 or 6 years. It was clearly a no-brainer from 2019 to 2022. It's not anymore.
We've spoke on this podcast a lot about the labour markets, and we had the opportunity, Dick, you spoke about it on a live webinar last week with Geeks, Geezers and Googleization, and Matt, you weighed in. It was a lively debate on the latest Bureau of Labour Statistics numbers. And I'm also following Jeffrey A. Tucker, who is founder and president of the Brownstone Institute. He says the Bureau is fast becoming a running joke. He says the mainstream media repeats the Bureau's, and his words, fibs, and Tucker repeats the reasonably good news we spoke about on this podcast, that the US in October added 150,000 jobs, but then goes on to temper the good news, noting that the US also axed 384,000 jobs in the same month. You and Matt and Dick, you've gone through a lot of these numbers, but just wanted to give you some of his insights. Tucker then claims the US is not only already in recession, but we probably never truly recovered from the March 2020 recession. He says the trend line is not improving, but getting relentlessly worse. And he notes also the rise in part-time jobs. And he says a lot of this is, in his words, White House propaganda to kind of make us feel that the economy is on the mend, we're creating all these jobs, and actually beneath the surface things are really bad, in his words.
Yeah, well, you may have remembered Jack Welch, who was the CEO of GE a few years back, when he was on CNBC. He's since passed away, but when he was on CNBC, the labor numbers would come out and he would throw an apoplectic fit, over, it's political. They're making up these numbers. They don't mean anything, and I don't believe that they were political, but I do believe they can't do what they're trying to do. And I think that, the press has to have something to talk about. And they made the decision that talking about the labor numbers was something that they really thought was important. So every month when the labor numbers come out, they have a panel of 3 or 4 prestigious people, and they, opine on the labor numbers. And therefore, everybody now thinks the labor numbers are important. They are lagging indicators. They are not leading indicators. And most of the numbers that are put out, not willfully, but are wrong, because you can't have the government come in and tell you that, the household numbers are down by 300,000 plus, and the establishment numbers are up by 100,000 plus, and have a straight face. But they do it. And the press eats it up, and we're supposed to believe it. I don't believe anything that comes out of the Labor Department other than the unemployment numbers, because, again, they're not willfully trying to make something wrong, but they are putting out numbers which make no sense whatsoever.
I mean, when we discussed this a lot, talking about whether you trust them or not. My only gripe is I just want to make sure. I would love to know, and I believe that they're just using the consistent month-to-month practices, and they're not changing the practices based on politics or based on some sort of ambiguous measurement, but they're actually just, hey, these are the numbers. They are what they are. Because as long as they're consistent, no matter how many errors are built in, it's still going to capture the directional change of employment. And it's clear that employment has been softening, but if you were to drop in from Mars and having known nothing about our economy, and you were told, hey, these guys have 3.9% unemployment, you would think that that's a pretty healthy economy. And it really wouldn't show the structural problems underneath the economy, the number of people with 2 part-time jobs that would rather have a full-time job, or the number of people that have a full-time job but can't make end meets and have to have a part-time job on top of that. And so I think that's where the biggest disparity is coming in, is that while we have a low unemployment rate, the pay is not there to compensate for the massive amount of inflation we've had under the current president. And so you have this kind of disparate reading of the employment situation, because people have jobs, but they're just not getting paid enough in their one job. They have to have 2 jobs to make ends meet.
Jeffrey Tucker says we're in a recession by his reckoning and definition, I suppose, and we may be headed into a recession. And any thoughts on that?
Well, I've been saying it for a long time. I think Q4, Q1, I think it's coming. I think it could already be here. I think in hindsight, you could look back. Everyone's been talking about the Somm rule. I don't know if you know about the Somm rule, but it's Claudia Somm. She used to be an economist with the Fed, and it kind of came from a different perspective than I would share. But her rule was we need a trigger before a recession hits, but some sort of trigger that tells you a recession is definitely on the way. And her opinion was that when that trigger is tripped, that the government should have automatic economic stabilizers built in, where money gets sent to the people who need it to kind of shore up the economy so that it prevents a wider recession. And the Somm rule is when the unemployment rate for a 3-month average it exceeds the lowest level by 50 basis points. And so a lot of people thought the Somm rule was triggered last month or last week when unemployment came in at 3.9%, which is 50 basis points above the low of 3.4%. And she came out and was like, no, it hasn't been triggered because it's a 3-month average, but it's getting close. And if that's triggered, the Somm rule was invented when she looked backwards to try to find an economic indicator that a recession was about to happen that always worked backwards looking. And just because it always worked backwards doesn't mean it's going to work in the future, but we're getting close. And so unemployment rising 50 basis points from its low is one of the signs that, the Fed is watching. So I kind of think, the Somm rule is almost there. You have the yield inversion, which is again a perfect indicator looking backwards whenever the yield curve gets inverted. You have a recession within 12 to 18 months or 24 months, 18 to 24 months. And that happened in 2020, even when we had the recession in March of 2020, which we may not have recovered from. But, the BLS determined we had a recession for a good few weeks. And that was predicted in 2019 when the yield curve inverted. So a lot of the economic indicators that have really good track records are pointing towards a recession, and the timing is pretty close.
The traditional barometer is two consecutive quarters of declining GDP is the traditional barometer.
Remember, if you go back to 2022, we did have 2 consecutive quarters of decline, and it was heavily debated. Is that the measurement, or is it something beyond that? And one of the things that was being argued back then was, yes, we have declining GDP, but it's in an inflation growing economy. Like dollars on dollars, the economy was growing, and also the unemployment rate was falling at the same time. And so, the people that vote on these things kind of got together and said it's not just two consecutive quarters. You have to have the other factors. You have to have consumer spending drop. You have to have unemployment rise a little bit. So yeah, the traditional method is 2 quarters of GDP, but I think we all learned that doesn't apply necessarily all of the time.
Yeah, what I've been trying to do is figure out why, because I believe we're headed for a recession also, but why hasn't it happened? So, again, I like to look at numbers, so I go back through the numbers and I come back to the period of 1930 to 1947. And in that period, in the beginning of the period, there was a tremendous destruction of wealth. But, when World War II occurred, people were working, because they were in building tanks or weaponry or what have you, or fighting in the war, and they were building up income, but they couldn't spend it because there was nothing that they could buy, because the car companies were building tanks, not cars. The tire companies, I remember everybody used to buy old tires and then use glue to stick it on the tires that you had to make the tires still work. You couldn't spend the money that you were developing. So then the war ends and we go into the period of the 1950s, and that's beautiful, right? Because now you have all this excess money, the banks are loaded with excess money, and the money flows out into the economy, allowing, economic growth to be somewhat above what we have considered to be average now. So I'm comparing that to, again, COVID and the numbers that we see that built up in that period. And I'm just wondering if what's delaying the inevitability of this recession is similar to the World War II, post-World War II phenomena, where you've got all this money and you're spending it. And as I say, from the numbers that we looked at over the last, week, there's a huge amount of money, a staggering amount of money, which households in the United States have that I guess is going to continue to be spent. And I don't know how long it's going to be spent. But the point is, I think that's what's preventing this recession, because as Matt said, and I agree with, basically all of the indicators that are core would tell you that we're going into a recession.
And Americans are saving less. I think the savings rate just dropped to 3.4% from 4% in August, which is low anyway, but the last of the COVID money is disappearing.
Yeah, well, it may be disappearing, but it's not disappearing as fast as they would have you believe. If we take, the wealth of the assets of the American public in the first quarter of 2019, it was $126 trillion. If we take it in the second quarter of 2023, it's $174 trillion. It's never happened before. It's never happened that you get $48 trillion increase in assets in the hands of the American population in what turns out to be a 3.5-year period. It just has never happened. And again, you got to go back to the other period in American history where all this wealth was built up but couldn't be spent. And that's similar to what we saw in the COVID period. And so I'm assuming that we don't get the recession because basically we're still spending that money that was built up in a period when it couldn't be spent.
This is a phenomena that is just fascinating, and because Matt has spoken about Japan quite a lot, about yield curve control, getting very technical here. But inflation is now rising in Japan, and they're doing cartwheels, and deflation is crept into the economy in China, the exact opposite.
Yeah, well, Japan has taken off. All the controls are off in Japan. And, they let the yen, I don't know, a decade ago, the yen was almost parity. 100 yen equals a penny, and now it's 160 yen. the currency has finally collapsed, and the world has finally understood again what Matt has been saying about Japan, right? In the case of China, you're destroying wealth because basically all these real estate projects are going under. And all this money that they've loaned to countries around the world, these countries are not paying them back. So I think the reason why Xi Jinping is going to meet with Joe Biden on Wednesday or tomorrow is
in California.
Yeah, in California, because he recognizes that, he's got to get foreign investment in his country again. And after all of the controls he put on to stop foreign investment, he's got to take them off and he's got to let the money flow in. So, this meeting will be very, very important. But I think in one case, you got a destruction of value in real estate. In the other case, you have a change in the financial policies, which is why Japan is inflating and China is deflating.
And we have other developments across the globe. The war in the Middle East, Israel on the offensive against Hamas, and just a huge, sickening death toll. And in Ukraine, the latest reports, if they are to be believed, are not encouraging, at least for the Ukrainians. And there was an opinion poll shows Ukrainians have grown less optimistic since May of success, when hopes back then were still high for the summer counter-offensive. It didn't seem to go well, because you never know, some of these reports, the fog of war sets in. That's a bad situation in Ukraine, and also, of course, in the Middle East. I'm just wondering how it might play out, what we should be concerned about here for the globe, for the economy, political stability.
Well, the market says it doesn't matter. The stock market is saying, they've been fighting in the Middle East, for as long as anyone ever can remember. In fact, if you pick up the Bible, you see Moses comes out of Egypt and he goes to the middle, to the promised land, and that's what they're fighting on. And they've been fighting over it for 5,000 years. And so, unless Iran is going to become much more active, and I don't think they are, because I think they're afraid that Israel has nuclear weapons. But anyway, whatever, I don't think Iran is going to become more active. Then a lot of people are going to be slaughtered for in my view, very, very little reason at all. And that doesn't mean I don't understand that, if I lost my wife and daughter, over some rapist coming in and killing and shooting them, I wouldn't feel the way the Israeli feels. But I mean, it's not going to affect the markets. In Ukraine, you have what the markets might consider to be an ideal situation. Neither side is winning, but they keep, shooting each other. And therefore, it doesn't have a tremendous economic effect, except, defense stocks tend to do really well because, they can't create enough bullets fast enough. But the market just doesn't care about it, just does not care about it.
Well, we see the price of oil dropping at the pump, so there's no interruption on oil supplies, unless that's an indicator also of some kind of harbinger of recession. People are not spending as much, or they could both connect.
Yeah, no, I think it is a harbinger of recession, but the point is, that's the point. It hasn't affected anything. These two wars have affected the people who are involved in them, horribly, right? But it hasn't affected the world financial situation, and it hasn't certainly affected the markets in the United States.
And by the way, this is not unique to this time period. I mean, you go back to World War I and World War II, and the markets really didn't take into account the wars until it actually impacted economic activity on the ground. And so at the moment, these wars are far away, but the Middle East is where a lot of the world's oil comes from. You don't have to imagine and be too creative to come up with a scenario in your mind where oil prices spike due to a massive change in access to oil, or maybe for some reason the Persian Gulf is shut off due to activity that is occurring over there, and all of a sudden, oil could go to astronomical levels overnight just because of something. So the risks are there, but it certainly doesn't feel like anyone's paying attention or it's priced in right now.
Speaking of war, Dick, America was in a terrible depression. The globe was, or most of the West, or good sections of the West, in a Great Depression during the 30s. And then we entered the Second World War. We gradually came out of that, correct? And then the 50s were boom times.
Yes. In other words, the World War II put a lot of people to work who couldn't find jobs, and the need for manpower, both to fight and to create weaponry. My father was 4F, but he went to work in the Ford factory, building tanks, right? Because he couldn't go in the front lines. So the point is, all these people had to go to work to support the war effort, and that caused a revival in the U.S. economy. And again, because they couldn't spend the money they were making, they didn't spend it until the 1950s, and then we had a really wonderful period. We had 53 and 57 that were recessions, but we had generally good economic times.
And then we had this. I just saw a documentary really interesting on the road building program in America in the 50s. The highway system. I mean, the amount of money that was spent on that was just phenomenal, and that led obviously to spending and to productivity gains as well.
Yeah, no, I personally think Eisenhower was one of the greatest Americans that ever lived, and that was his program. In other words, his program was to build an interstate highway system that would open up all areas of the United States, and they did it, and it was beyond belief successful.
Are we looking at a massive year-end rally in the markets?
Well, I really don't think so. But the point is, the market's up over 500 points today. It was up less than 500 points when we started talking. Again, if all this money is sitting there and people think that that the only reason to buy stocks is because the Fed might decrease rates, then the market will rally. But if they think about what is really happening underlying in the economy, then that rally will peter out pretty soon. But today is no indication that anything's going to peter out. It's just exploding on the upside.
Sorry, everyone's optimistic right now, and this is boom times are back. I remember 2008. I remember 2000. When the time comes for the turn, it's not because everyone's sitting here being like, oh, by the way, things are great now, but I think it's going to be bad by December. No, it turns, and it's only looking backwards that you realize when the peak was. And everything is just so priced for the perfection. And, I feel like it takes a long time for these interest rates. I mean, we've had 500 basis points of increase in one basically calendar year. And the Fed's never raised interest rates that high. So there's no that high, that fast. There's no historical correlation. You can go back and be like, okay, how long does it take before it trickles through the economy? But we have record number of bankruptcies. We have record number of defaults on car loans. We have record number of credit card usage. Like, there's a lot of indicators out there that say the economy is about tapped out. And when it happens, we're not going to know it until after the fact.
Yeah, no, I think that's exactly correct. But again, we got $174 trillion sitting in the hands of the American population, and that's ameliorating the blow, which I think is definitely coming.
Right.
It's always good to finish, at least on this episode, on a very positive, upbeat note, because we've been sort of gloomy some of the past episodes, and we'll come back to all of this next week for episode 96. And until then, Dick and Matt, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.